Okay. Well, welcome everybody. We're really glad to see you. This is a kind of a special community meeting hosted by the San Francisco Creek Joint Powers Authority and City of Palo Alto regarding flood insurance changes and the changes in the cost of flood insurance. So thanks for coming. My name is, the slides up there I'll refer to quite a bit. I'm going to speak, my name is Len Matterman. I run the San Francisco Creek Joint Powers Authority, and I'm going to speak for about 5 minutes and then turn it over to Edie Lohman from the National Flood Insurance Program, and she'll speak about the changes to the program and take your questions. So I'm going to give a short overview of the flood threat in these communities, some of the numbers around flood insurance and the costs associated with that, to give you the context of, at least for Palo Alto, East Palo Alto, and Menlo Park, what are the issues in a kind of macro scale, not an individual scale like some of you may have. And the questions later are to address your specific concerns or questions or circumstances. But I'll provide kind of an overall context. And then also talk a little bit about what we're trying to do to get people out of the flood insurance program. So I think the first thing to remember is San Francisco Creek, which is the cause of one of the two floodplains that keep people in the flood insurance program in our communities. The other cause of flooding is the bay. And there are two floodplains, San Francisco Creek floodplain and the Bay floodplain, and a lot of people are in both, which we'll see, and a lot of people are in one or the other. But I wanted to just kind of, a lot of people think of the creek, and I think historically it's been viewed as a divisive liability, and one of the things we're trying to do at the JPA is turn it into an asset, and in fact a unifying asset among these communities. So it's always good when we talk about flooding and the costs of flooding to think about kind of some of the aesthetic features of the creek and what we all like about it. This picture shows both what we like about it and in some cases what we don't like about it. This is a picture of the Pope Chaucer Bridge. Obviously it's a nice setting, but the culvert that was created causes flooding for Palo Alto and Menlo Park. And this is an area closer to the bay. To the left, you see homes with roof lines below the tops of levees, and these levees aren't certified, they're unsafe, and our first project is to address that condition for East Palo Alto. So to take a quick look at the 100-year floodplains in the three cities, this image shows in multiple colors the creek floodplain, which is green in green, and there are about 3,500 parcels that are in the 100-year floodplain. And in the Bay floodplain, which is the kind of blue purplish color, there are 2,700 parcels, and in both floodplains, as you can see from the red arrow, there are 2,200 parcels. To give you some context, you could probably see, but off to the upper right is San Francisco Bay, the big black line cutting through there, through the image. From the upper left to the bottom right is Highway 101, and the creek is that blue line that divides the picture. Flood insurance in Menlo Park, East Palo Alto, and Palo Alto. There are, as of the end of February of this year, so it's current numbers, a little over 5,200 insurance policies, and the total amount of premiums is about $7 million paid by property owners in the three cities. The National Flood Insurance Program was begun in 1968. In the 46 years of the program, the total payout over those years has been $9.42 million paid on 533 losses. So every year we're paying in now about $7 million. Obviously that's higher than it used to be. It goes up consistently, as most of you probably know, and the total payout is a little less than $9.5 million. We believe at the JPA it's a better investment to take yourselves out of the floodplain than to pay for insurance being in the floodplain. And so that's the focus of our activities. Final slide is to talk about the project plans, which are those activities. Again, we see these three floodplains, of the green being the creek floodplain only, the blue or purple being the bay floodplain and the red being the commingle of both floodplains. The first phase of construction that's planned is from the bay to Highway 101. You'll see those yellow lines come up, and the area around those yellow lines turn from red to purple. What that means is the project plan has us building flood walls and levees, and because we intend to, through that project, take people out of the 100-year floodplain, they are no longer in the red area or both floodplains, but they're only in the bay floodplain because this is a creek project only. The next phase of projects is actually, the next project is not ours, but it's very much related to what we're doing, and we're working closely with Caltrans on it. It's a Caltrans project to rebuild Highway 101 over the creek, and that's a really vital piece of our whole project, comprehensive project. The next phase is upstream, and the yellow circles refer to the Newell Road Bridge. Most people probably heard that the City of Palo Alto is looking at a new Newell Road Bridge, working with the City of East Palo Alto, and there's an EIR that's underway right now, an environmental impact report. The other circle farther to the left or upstream is the Pope Chaucer Bridge, and that, of course, is a bridge that caused a lot of flooding in 1998, which was the flood of record. Most of that flooding was in the Palo Alto community. The three X's refer to bottlenecks in the channel that we also need to address. The combination of all of those, which is the subject of an EIR that the JPA is doing, and that is to allow all of the water that can come under Middlefield to make its way to the bay without overtopping. That would be almost equivalent to the 1998 flood of record, which was estimated to be a 45-year flood, and it caused damage to about 1,700 properties. So our goal with this suite of projects through our EIR, and this suite of projects is funded. As you may have heard, we're working on permits right now, and there are some challenges associated with that, but it's a funded suite of projects, and we're looking at the upstream area with our EIR. The next phase gets to the flood insurance issue, and that is 100-year protection upstream of Highway 101. There are three fundamental alternatives to that. You either keep as much water as you can in the channel, more water in the channel, or you take water out of the channel before it even gets to the floodplain area, that's upstream detention, or you take water out of the channel and route it around the floodplain, that's a bypass. So we're looking at those three options through our EIR. The goal of that would be to remove the all areas actually from the creek floodplain, and so what you'll see when those projects are implemented, and this is a ways off, would be to get rid of the green and turn the red into the blue. So everybody's remaining floodplain is just the bay. It's a lot of work, it's complicated, multiple agencies, and the next phase of projects, some of which are actually starting design, are related to the bay, and that gets rid of the tidal floodplain overall. You see a couple areas with dotted lines. Those are areas that either cannot be dealt with through our current design, or they're being worked on through a separate project run by the Santa Clara Valley Water District on the Palo Alto side of the channel. The JPA is working on a bay project north of the channel for East Palo Alto and Menlo Park. And that's it for me. Thanks for your attention. I'm going to turn it over now to Edie Lohman, and she can talk about the flood insurance changes and the program itself and take your questions. Thanks.
Novel concept. Good evening. Everybody hear me okay? Well, thank you for your time. I realize that you probably all have much better things that you would rather be doing tonight, but I hope we can tell you a little bit about the flood insurance program and certainly answer some of your flood insurance questions. I am from the Federal Emergency Management Agency, Region 9 office out of Oakland. I am a National Flood Insurance Program insurance specialist, so I do all things flood insurance 24/7. I'd like to also introduce Olivia Humilde. She works with me. She keeps me out of trouble, actually. She's with the External Affairs branch of the Federal Emergency Management Agency. And we're both very happy to be here tonight. So what I'd like to do, we have, as you probably very well know, a lot of things going on with the National Flood Insurance Program these days. So I'd like to give you a little bit of an overview about the program and then talk to you a little bit about some of the changes without overwhelming anybody, hopefully. And I'm here to, more importantly, answer your questions. So I will try to be brief and give us a lot of time for questions and comments and those kinds of things. So if at any point there's some place you'd like me to stop, I'd be happy to do that. So feel free to jump in. NFIP stands for National Flood Insurance Program. So you'll see that I've abbreviated the National Flood Insurance Program on a lot of my slides to NFIP. That's what it stands for. The primary goal of the National Flood Insurance Program is the protection of lives and property. That's what our goal is in this program. We recognize that even today, 70 to 80% of all the natural disasters across the country are flood-related. Flooding kills the most people and it causes the most damage, and certainly because we don't hear about it in the news all the time here in California, that doesn't mean that somebody isn't flooding every time we turn around, because we do have some significant risks. The whole state is coastline, and we are one of the most levied states in the country here in California. And I think that we don't often think about that sometimes because it's so dry here. And you know, right now we're in a drought, and people say, but you're talking about flood insurance. We're having a drought. But the thing about flooding is it's a little bit unique because we have droughts here on the West Coast, right? We're in one now. And so with the droughts come the wildfires. It comes with the risk of decreased water tables, and then we're watching the stability of all of the levees countrywide. And so when we have wildfires and then it rains, what happens? Right? We get wet. We have no vegetation on the landscaping, and the water runs down and tends to increase the threat of flooding. We also have earthquakes in the state of California, which really jeopardize some of our flood control projects and our things like our dams and our levees. We have to be concerned about those in the event of an earthquake. Part of our region covers Hawaii. As it turned out, I was over there about 2 or 3 weeks ago, and it was my last day, and I was packing up, and I was staying in Waikiki, actually, on the Strip, and my BlackBerry went off, and it was the emergency notification system because there was a big earthquake, right? And not in Hawaii. It was in Chile. That's right, Chile. But that sent off a notification for the entire coast of California as well as the coast of Hawaii. So we do have some unexpected, sometimes, threats of flooding here that we shouldn't forget about. But what we're trying to do is preservation of lives and property. So I'd like to give you a little bit of background about how the National Flood Insurance Program works. Basically, communities voluntarily participate in the National Flood Insurance Program, and in exchange for that, they agree to enforce what we call minimum floodplain management regulations and ordinances, and they adopt the FEMA flood insurance rate maps. So the floodplain management ordinances and regulations have to do with how we build buildings that are in high, low, and moderate risk areas of flooding. Because everybody's in a flood zone. It just depends on whether it's a low risk, a moderate risk, or a high risk of flooding. So they agree, as a condition of participating in the program, to regulate how new construction and improvements are done. And in exchange for that, FEMA, who oversees the day-to-day operation of the National Flood Insurance Program, makes flood insurance available to the property owners within that community. So that becomes an important detail here in a minute. We basically have three main components to the National Flood Insurance Program. We have, this is our three-legged stool that you see on the slide, as we like to refer to it. So the first part of the National Flood Insurance Program has to do with the mapping. These are the FEMA flood maps, and these are the maps that show whether you are in a low, moderate, or high risk of flooding. These are key documents that we have in the National Flood Insurance Program because we use them for public outreach. So we use them to educate the public on what their flood risk is. We also use them to determine who's in a high-risk area where flood insurance might be mandatory if you have a federally backed loan. We use them to some extent to determine what your flood insurance premium is going to be. So the maps are really, really, really very important. We also use them to regulate new construction. So if you were going to build a structure that was in a high-risk area on the FEMA flood insurance rate map, there would be certain rules and regulations as far as building it out of harm's way. Because in the high-risk areas, we work with the local communities, and we can tell you how deep the water's going to get, whether it's going to reach the doorstep or whether it's going to be over the roof. And that is technically called the base flood elevation, or the BFE, but it simply tells you how deep is the water going to get in this high-risk area. So we put that right on the flood map, and floodplain management is all about regulating to FEMA's flood insurance rate map. Because if we have spent the money to do the studies and we know where the low, moderate, and high risks of flooding are, and in the high-risk areas we know how deep the water is going to get, we don't want to be issuing permits to build new construction at levels that are below where we think it might flood, just because that is just not good business sense. The third piece is flood insurance, and that works hand in hand with floodplain management in that the higher you build out of harm's way, the cheaper your flood insurance premium. So if you're in a high-risk area and you build significantly higher than the level that we're expecting it to flood to, or if you're doing a major remodel or improvement, you build higher, then your flood insurance premium will reflect that. And the local communities monitor how those floodplain management regulations and ordinances are put in place, and they monitor the permit process. In fact, East Palo Alto and the City of Palo Alto do more than the minimum requirements, and they're in a program called the Community Rating System, or CRS, where for those of you that live in East Palo Alto or the City of Palo Alto and you have buildings that are in the high-risk area, or what we call the A zones or the V zones on FEMA's flood insurance rate maps, you get a 15% discount on your flood insurance premiums every year because they go above and beyond the minimum requirements to be in the program. And for those of you outside the floodplain, in the low to moderate risk areas, you're eligible for 5% discounts. So we appreciate that, and the communities actually earn points by having some of these public outreach briefings and some other activities that they do that put them in these various categories for discounts for the flood insurance policies. Okay. So these are the maximum limits of coverage available under the National Flood Insurance Program. You can purchase for residents currently up to $250,000 of building coverage and up to $100,000 on contents coverage. And for non-residential properties, which is for the most part are commercial structures, anything that wouldn't be residential, where people are living, you can purchase up to $500,000 on the building and up to $500,000 on contents coverage. And where do you purchase flood insurance? This is a common question. The National Flood Insurance Program really doesn't have a 1-800 number that you call up and buy a flood insurance policy. You have to go to a local insurance agent to have a flood insurance to buy a flood insurance policy. We have about 90 what we call write your own companies, which are private insurance companies partnered with the National Flood Insurance Program to allow us to get the policy out to the general public, because a lot of people don't know what the National Flood Insurance Program is, but they do know who their local insurance agent is, and they'll go to their local insurance agent and ask about flood insurance. And it's also a way for us to get private industry as a partner with us in the National Flood Insurance Program so that we can comply with some of the general standards of the insurance industry. So just at a glance, the National Flood Insurance Program currently has 5.4 million policies countrywide. We have over 22,000 participating communities. And these statistics are not as current as yours, so you beat me out there. But great minds think alike, right? So this is kind of a breakdown of the number of flood insurance policies. These numbers are actually of December 31st, 2013. But I wanted you to see exactly how many policies we have in each of these communities here in this area. And California, by the way, ranks 5th as far as the number of flood insurance policies in the nation. So we do have quite a few flood insurance policies here in California. Historically, the National Flood Insurance Program hasn't changed a lot. As was mentioned earlier, it was introduced in 1968, but I want to tell you this little story because it kind of leads into our discussion about how the NFIP is changing and why it's changing, which is something that you probably won't read about in the media. You have to be working in this program for a little while to know the history. So I can say I'm old now, so I know a little bit of history, and I think it's worth hearing about. When this program was introduced, it was introduced as a voluntary program because private insurance did not offer coverage for flood or flood-related damages at the time. And so the only other alternative was disaster assistance. And disaster assistance is taxpayer dollars, and not every event is federally declared. It has to meet a certain dollar threshold to be federally declared. So Congress was seeing an increase in flooding events countrywide, and they also recognized that private insurers were not offering flood coverage under a standard homeowners policy. It was specifically excluded. So they said, okay, we're going to introduce the National Flood Insurance Program. And they did that under the National Flood Insurance Act in '68. And so when they introduced the program, they had a little bit of a theory going. They said, okay, we know that we have some older buildings that are existing, and they're in floodplains. They're in high-risk areas. We know that. We also know that we don't have a mechanism at this point in time, right now, to mitigate their flood risk. And we know that if we have to charge the full risk rate for those buildings, because they were older and they were already there, which means they could have been built anywhere, anyhow, anytime, because we hadn't done the studies, we didn't have the flood maps, and there was no regulations in place to tell them how they should have been built. We know we have a certain percentage of building stock in that category. So we're going to subsidize those policies for those property owners. And that will allow them to be able to avail themselves to a policy for flood insurance at an affordable rate. Going forward, as communities participate and join the National Flood Insurance Program, and we've done the studies and we have the flood maps, we are going to require that anyone who builds in a high-risk area or the low to moderate risk area complies with the ordinances that the community adopts going forward to be in the program. And those structures will be built to the best available data, and they will be less at risk, and they will be full risk rated because their premiums will be cheaper because they're not as at risk for flooding. So fast forward to 1973, and there was a big storm in 1972, and I know at least one person in here is from the East Coast, who shall go nameless, that I talked to earlier. But for those of you that may be from the East Coast, others, in 72 there was a big storm called Hurricane Agnes. Anybody remember that storm? Okay, got a couple of people in here. So what happened was the flood insurance program paid less than 1% of the damages from Hurricane Agnes, and that was a big storm. It wiped out the East Coast, basically, caused about $3 or $4 billion in damages, and that was a lot at that time. And we only had 95,000 policies in force. So how were the other damages paid? Federal disaster assistance. Taxpayer dollars, right? So Congress said, wait a minute, this isn't working as we planned, so what can we do? So they passed the Flood Disaster Protection Act of 1973, which said, okay, look, if we are doing these studies, which are intense and expensive, and we know where it's going to flood, we know how deep the water is going to get, and folks are using federal government money in the form of federally backed loans, if they have structures in these high-risk areas, which are the A and the V zones, so any flood zone that starts with the letter A or any flood zone that starts with the letter V, then under the Flood Disaster Protection Act of 73, we're going to make it mandatory to have flood insurance if you have a building in one of these A zones or V zones and it has a federally backed loan on it. So we updated the program in 1994 and in 2004 to address some older buildings that we thought we might be able to mitigate. This is the older building stock now in high-risk areas, and some of the structures that are repetitive losses. So we did that in 94 and 2004, and then we get to July 6th of 2012. Now before we talk about the legislation that was enacted and signed on July 6, 2012, right about in, why don't we go ahead and go to the next slide, right about around early 2000, FEMA had been talking with a lot of the academians, meteorologists, all the scientists who study weather patterns and so forth. And they had said, or they had predicted, and they still do, that there would be an increased number of flooding events due to a lot of different factors, and the severity of the events would increase. So FEMA, because they're an emergency response agency and they are responding in all types of disasters, they took that information seriously, and they started to look at the National Flood Insurance Program and said, well, you know, we probably need to do some things with the program to make sure that it remains stable. Because here we are in the early 2000s, and we still don't have private insurance carriers that are actively participating in offering flood insurance to property owners. We do have some private insurance companies who offer flood insurance, but it's selective, and they are able to come in and out of the market, and it's not evenly available to everybody. So then what happened is, in 2005, we had what? We had Katrina, Wilma, and Rita with the National Flood Insurance Program. So we paid about $17 billion in flood claims in those three events, which was more than the whole history of the National Flood Insurance Program. And when the program was set up in 1968, besides the subsidies for the older buildings with the idea that they would retire over time and become all compliant buildings or mostly compliant buildings, the other thing that occurred was that the National Flood Insurance Program was set up as intended to be a self-funded program. So all the policy premiums that were collected would pay for everything to operate the program. All the engineering studies, all of the claims, everything. But they had borrowing authority, and still do, with the U.S. Treasury. So that was kind of our reserve fund, and still is. But the National Flood Insurance Program is a line item on the budget, just like everything else, and they have to pay that money back to the U.S. Treasury with interest. So in 2005, when Hurricane Katrina, Rita, and Wilma hit, it was pretty alarming, because now we're $17 billion in debt, and how are we going to pay that money back? And everybody said, well, you know, that was a freak storm. That was kind of a really odd thing. Probably, maybe that won't happen again. And so in that time frame, this program has to be authorized by Congress every so many years, because it is a line item on the budget. So around 2008, we had several, why they were trying to figure out, you know, what should we do? Because this is a little bit of a quandary if we don't have a solid private insurance market offering flood insurance, and we only have the National Flood Insurance Program and federal disaster assistance if it's a federally declared disaster. So around 2008, we had a period where this program saw some short-term time periods where it wasn't authorized by Congress. And that was a problem, because if you were purchasing a home and it was in a high-risk area and you were getting a federally backed loan, you wouldn't be able to buy a policy for flood insurance to close the loan if the program was not authorized by Congress. So that was one thing that they needed to look at. Now fast forward to 2012 in October. What happened in 2012? Superstorm Sandy, right? So here comes another gigantic storm that everybody said back in 2005 wasn't going to happen again. So as it turns out, all the scientists and all the meteorologists and all the people who spend their days studying the weather and the climate, well, they're starting to be right. Now we have Superstorm Sandy. So Superstorm Sandy now put the program in about $24 billion in debt. And that's where we are right now. And we still don't have a lot of private insurance offering to cover flood or flood-related damages under homeowner policies or separate policies. There is some private flood insurance out there, but it's not an even playing field. So we're really no further along than we were back in 1968 in that respect, as far as having more options for people who are at risk for flooding and who have flood damages. So back in July 6 of 2012, they passed the Biggert-Waters Flood Insurance Reform Act with the idea that we would be able to put the program on better footing pretty much from all angles. And it's a complex piece of legislation, but one of the primary goals of that piece of legislation was to extend the program for another 5 years. So under the Biggert-Waters legislation, they reauthorized the program through September 30 of 2017. So this gives us a little bit of opportunity to take a look and see what we can do, talk to our private industry partners and our federal, local, and state partners, and put our heads together and see what we can do to continue to be able to protect lives and property from the risk of flooding. So the Biggert-Waters Reform Act, which I shortened to BW12, that's what the acronym BW12 stands for on the screen, is a big, big piece of legislation. And it's not all about the flood insurance. It's not all about raising flood insurance premiums. It takes a look at every single part of the program. If you remember the three legs that we talked about a few minutes ago, the mapping, the floodplain management, and the insurance, the Biggert-Waters legislation has provisions in it for all three of those, and also what we call the risk reduction. So it's looking at the program as a whole, saying, okay, let's see where we can make improvements. Let's use the best technology we have, the best expertise that we have, so that we can try to mitigate damages before they occur, so that we can update the maps to make them the best that we can be, so that property owners have the latest and greatest information on the risk of flooding. And let's take a look at the insurance, because we still don't have private insurance in the market. We need to have these conversations with our private industry partners. But in the meantime, we need to look at the financial stability of the program going forward, because this is really the main game in town right now. And the alternative is disaster assistance. And federal disaster assistance is available in a lot of different forms, and but we have flooding events all the time. And so if it doesn't meet a certain dollar threshold, disaster assistance is limited. And even in the big federally declared disasters, it's generally limited for property owners to a grant program and to a loan program through the Small Business Administration. But what we really want to avoid is the notion that people will have to be dependent on disaster assistance because you may, in a federally declared disaster, you may get a small grant. I think the average grant is somewhere between $7,000 and $8,000, but you have to qualify for that. Maybe a little bit more, maybe a little bit less. But most people fall into the category of getting a Small Business Administration loan, which sounds like it's for a business, and they do have loans for businesses, but they also have loans for property owners. And so the grant program and the Small Business Administration, these are the two main programs for disaster assistance. However, what you need to realize is if you don't have insurance coverage for your loss, regardless of whether it's earthquake, flood, fire, and you're relying on disaster assistance, assuming it's available if it's federally declared, then if you go to get a loan for federal disaster assistance through the Small Business Administration, it's a loan. So you have to qualify for the loan. You have to pay the loan back, and you have to pay for a mortgage on a house you can't live in. Plus you have to pay a monthly bill for rent to live somewhere else while your house is being repaired. See, these are the things you find out on the back end, after the fact. And I'm what you call a storm chaser. So one of my other hats with FEMA, and I worked a good part of my career in private insurance industry, is chasing disasters. So I'm the person that goes to the disaster field office, and I'm the person at the table who talks to you about insurance you either do or don't have and what those options are. So I get to see how this rolls out firsthand. And that's why I'm sharing it with you, because it's not something that you will read very often in the media. And the way the public finds out is when something bad happens, and then you're in the middle of it, and you say, I wish I would have known. So the Bigger Waters Reform Act, although it had provisions in it for a lot of different pieces of the program that are moving forward, I want to focus the next few minutes on specifically the insurance, because I want to talk to you about what they passed under the Bigger Waters Flood Insurance Reform Act so that you can understand the most recent piece of legislation that was signed that modifies and repeals some of this. So we need to talk about this first. So there are really 18 provisions, 18 insurance provisions under the Bigger Waters legislation. We, FEMA, really only got to looking at two sections, what we call Section 205 and what we call Section 207. So Section 205, and I'm going to try to explain it in the most simple terms to make it easy to understand, I hope, even though it can be a little complicated, so bear with me. In the National Flood Insurance Program, we have two sets, well, we have more than two sets of policyholders. We have three pots. Let's say we have three pots of policyholders. We have what I call the Section 205 policyholders. These are the policyholders that have these older buildings, the ones that were built in the high-risk areas, in the A zones and the V zones, before there were any floodplain management regulations or ordinances in place. So they are the ones that were subsidized. Remember that story that I just told you not too long ago? With the idea that going forward, we would be able to mitigate those programs and bring them up to current floodplain management ordinances and code. Those are the Section 205 folks, and they're getting subsidized flood insurance premiums if they have the older buildings in A zones, V zones, or D zones. Okay, so keep that in mind. We're going to talk about them a little bit more. Section 207 is the second pot of policyholders, and those policyholders are eligible for significant policy discounts when they are when the maps are updated and their structure is moved from, let's say, a low to moderate risk area into a high risk area. Those policies are significantly discounted in the form of what we call grandfathering, or what we call the preferred risk policy eligibility extension. So the third pot of policyholders.
We probably want to get to questions in about 10 minutes.
Okay. So the third pot of policyholders are the policyholders whose structures were built after the community had their regulations in place, or they're in the low to moderate risk areas where flood insurance is optional. And so they're already full risk rated. They're already paying the full risk rate. So when Congress was looking at the National Flood Insurance Program to see how we could make adjustments, they were looking specifically at these two groups that you see on the screen, Section 205 and Section 207. So essentially, the subsidized policies and the discounted policies. And so those are the two groups that they targeted. And more specifically, under Section 205, they targeted the older buildings in the A zones, the V zones, the D zones that are non-primary residences, which are second homes and rentals, the business properties, and the 1 to 4 family severe repetitive loss properties. And we started to implement Section 205 January 1st of 2013. Section 207 never got implemented. It never got any further than the evaluation of that section. So it was in the Biggert-Waters legislation to phase out the discounts associated with map updates, but it was in the evaluation stage, and it wasn't being implemented. It has since been repealed under the new legislation. Okay, so next. Okay, so again, Section 205 really does apply to the older buildings in the A zones, V zones, and D zones. So if you're curious what we consider to be an older building or a pre-firm, what we call a pre-firm, pre meaning before firm, which is flood insurance rate map, these are the first map dates. So a pre-firm building is a building constructed prior to the community having its very first flood insurance rate map. And every community has their first flood insurance rate map is a different date across the country. It just depends on when they did the study and when they started to participate in the program. This provides a little bit of a summary in a nutshell, but under the Biggert-Waters, what got implemented that we had already started was 25% rate increases for pre-firm or older buildings that were non-primary residences, right, so right up here, non-primary residences, and for, in the red box, businesses and 1 to 4 family severe repetitive loss buildings. And so the third category, if you will, would have been anybody who purchased a new policy or let their policy lapse after a certain date in 2012, in which case they went to full risk rates immediately. They didn't get phased in rates at 25% annually. They went immediately overnight to full risk rates. And full risk rates means that we are basing your premium on the difference between your lowest floor and the level we expect it to flood to that's on the current FEMA flood map. So fast forward to March 21st, a couple of weeks ago, and one of the issues that came up, or one of the unintended consequences that arose out of the Biggert-Waters legislation was when we moved to full risk rating for the older buildings in the A zones, the V zones, and the D zones, about 50% of them benefited, and they actually saw a cheaper flood insurance premium than the subsidized premium that we had historically offered in this program. But the other 50% saw significantly higher flood insurance premiums when they were full risk rated based on the difference between where their lowest floor was and the level we expected to flood to. And some of those unintended consequences were pretty significant. So Congress went back and they said, well, wait a minute, our intent was not to drive people out of their homes. Our intent was to put the program on more stable footing because we want to be able to offer flood insurance evenly across the board. We want people to be able to protect themselves. We want people to be able to afford the flood insurance as an alternative to disaster assistance. So this is where the Homeowner Flood Insurance Affordability Act came in. So under the Homeowners Flood Insurance Affordability Act, which is what HFIAA stands for, I had to shorten that, it's too long. What actually happened in a nutshell is they're calling it Section 203 of the legislation. That is what is going to be implemented going forward. And essentially what that means is there is no change in that legislation for the older buildings that are non-primary residences, businesses, or 1 to 4 family severe repetitive loss properties. If they're pre-firm and they're in an A, V, or D zone, they will still continue to see 25% annual rate increases. However, those people that were required to be full risk rated immediately because they purchased a new flood insurance policy or they let their flood insurance policy lapse, beginning next week, actually, Wednesday, May 1st, next week, Wednesday, that is May 1st, I believe, we are repealing that full risk rating for those older pre-firm buildings that were required to be full risk rated overnight because they were either a new policy or a lapse policy. And they're reverting back to the subsidized rates that they had originally. And that will start for new and renewal policies issued next week. That's May 1st. There are some additional provisions under the Homeowners Flood Insurance Affordability Act of 2014 that will be implemented in conjunction with some of the provisions from the Bigger Waters legislation. But those are all still under evaluation. So now you know as much as we know, okay? And if you're wondering how all of this legislation impacts the communities here, I just kind of wanted to give you a snapshot. Those people who will still see, those policyholders who will still see the 25% annual rate increase because they have a older building in an A zone, a V zone, or a D zone, and they are a non-primary residence, second home, vacation home, business, or 1 to 4 family severe repetitive loss property, those are the policies that you see in the 25% rate increase column on the screen. And I just wanted to put the total flood policies up there so you could see what the comparison is. Okay. So we have an excellent flood insurance reform website that I want to make you aware of, and because we're updating this website literally daily. And so if you're a property owner, a realtor, an insurance agent, a lender, community official, or you are a person from a congressional office that's in here or the media, please, please refer people to this website. It's accurate information. All of the bulletins and all of the information to do with both pieces of legislation are being posted on this website. There's a map on here, a GIS map, if you're interested, that'll give you the statistics of how various communities across the country are impacted. And there's also a fact sheet, and Joe here was nice enough to print out 100 copies of these. So this is an overview of what's going on, kind of a synopsis of what we talked about tonight. So Olivia has a couple in the back there. Pick up a copy on your way out, or see Olivia or I, and we'll make sure that you have a copy. Maybe we'll go to the next slide. All of the Write Your Own bulletins to the insurance companies who write flood insurance and their insurance agents are going on this website. So if you go to your insurance agent and your insurance agent says, wow, I don't know anything about what's going on next Wednesday on May 1st, where did you get that information? You can send them to this website. There was a bulletin that just came out the other day that talks about the May 1st rollback to the pre-firm subsidized rates, and it's right on that website. If you want general information about the National Flood Insurance Program, or you can't remember that website address, I encourage you to go to floodsmart.gov. It's our education and outreach website. It's a fabulous website, easy to navigate, and it has links to everything you could ever want to know about the National Flood Insurance Program or FEMA. So, the key takeaways here are we are working on it. It is a work in progress. And really, we're trying to figure out the best way through the federal, state, local, private industry partners, collaboration, to figure out the best way to move forward. We want people to really understand what their risk is. We want them to be able to protect themselves. And we want to provide a mechanism for people to be able to mitigate against flood risk and to be able to build safer and smarter and to be out of harm's way, because it's a much better idea to be proactive than reactive. And, thank you, that's all I have for you tonight. You guys did fabulous, absolutely fabulous. So let's open it up for questions, and I'll do my best to answer your questions. I think we have a mic coming around. This is being taped, so we need to have you speak into a mic. So if you could just bear with us for a minute.
Yeah, Joe Teresi is trying to get the mic to work. Maybe I'll start with a question, Edie, that I thought about when I was, and then Joe can. Does the mic work?
Does it work now? Yes.
Yeah, it does. Okay. So Joe's going to walk out in the audience, but I'll start off with a question still.
Joe's going to be Phil Donahue.
Yes.
Now I'm dating myself.
So in what you said, there was a table that had two columns, one with California and 3 cities. And what I'm wondering is, for example, in East Palo Alto, for that column, about 1 out of every 9 homes was in the right-hand column. Does that mean that, or homes or properties, does that mean that that number of properties, for example, in East Palo Alto, will still see the 25% increase?
That's correct.
Even under the new?
Correct.
Okay.
So the people that were impacted by the 25% rate, the annual rate increases under the original Bigger Waters legislation that was signed in July of 2012, and those are 3 categories. Those are the older non-primary residences, so that means they're vacation or second homes. They're a business, or they're a 1 to 4 severe repetitive loss property, and they're in A zones, V zones, and D zones. So those are the 3 categories.
And the only other question I have, and Joe, if you want to head out to the audience and get from people questions. The only other question I had was, even with the new legislation, rates are still going up, right? I mean, they're not going to go to actuarial rates and 25% increases, but we'll still see annual increases in the program for everybody. Is that true or untrue?
Historically, this program, the actuaries review the rates every year, and they adjust the rates. Some of them go up, some of them go down. The Homeowners Flood Insurance Affordability Act it has some very specific detail in it about rate adjustments. And so FEMA is taking their marching orders from Congress at this point, and they're working with Congress to understand what adjustments need to be done with these rates going forward. So I think, though, overall, to answer the question flat out, yes, I think you can expect to see that there will be some rate increases going forward, but they're going to be under the specific requirements of the law.
I'm gonna come into the audience with the microphone and let folks ask questions. But I think if I could, I'm gonna ask two questions that I have that I think many of you may also have. My first question is, okay, say I own a home in Palo Alto or Menlo Park or East Palo Alto. I own the home, and so my understanding is I'm not going to see any impacts on my flood insurance as a result of these two pieces of legislation because it's a primary home. Is that correct?
Right. So, so you have two things come to my mind. So if you don't have a mortgage on your house, first of all, then flood insurance is optional for you. You don't have a lender requirement if you don't have a federally backed loan, or the structure's not in a high-risk area, which are the A zones and the V zones. That's where the mandatory purchase requirement comes in. But if you're in a primary residence, you're not going to see 25% rate increases. What you will see are the annual rate adjustments that this program has done historically since the beginning of time. So that's what I believe it is in the Homeowners Flood Insurance Affordability Act. And that doesn't necessarily mean that any category or any specific category is going to go up 18% every single year for the next 50 years. I think, and that's still being evaluated, but they can increase them up to 18%. Is what I believe.
And then my second question has to do with a question that we've been getting a lot at our public counter here at the city, where people are being contacted by their lenders and being told that they have to go out and get an elevation certificate performed by a surveyor. What's that all about?
Okay, good question. So the elevation certificates have always been, that's been a question since time and eternity. Really unrelated to the legislation per se, but somewhat related. It's become a more popular question with the legislation because one of the ways that we full risk rate buildings is through an elevation certificate, because that tells us the difference between someone's lowest floor and the level we expect the floodwater to get to in that area. So lenders don't need elevation certificates, to answer your question flat out. The elevation certificates are used for a couple of different purposes, but for insurance, they are used for rating when you're full risk rating a structure. So some of you have older buildings and you'll benefit from having an elevation certificate by having it completed and giving it to your insurance agent, and some of you won't. It's just that simple, and it's about 50-50, and it's really hard to tell. These two guys are familiar with the neighborhoods here. They're also engineers, smarter than me, and they might be able to, I don't want to put them necessarily, box them into a hole here, but they might be able to give you a general idea whether you're above or below the base flood elevation on the map. But the elevation certificates are used to rate structures. They're also used for mapping purposes, but that's a topic for another time.
So I'm going to go around now and ask questions. I think we had a question here first, and I'm going to ask everyone to speak right into the microphone because this meeting is being cable cast and it's important if you want to be heard on the broadcast to speak into the microphone. So I saw your hand first.
Thanks, Joe. I had two questions. The first is sort of a follow-on to that. My house was built in 1948. I've had flood insurance for a long time. Unfortunately, it lapsed for a couple of days last year, and so then it's like I'm in the special category now. But the two insurance companies who I've asked to give me quotes have said they refuse to give me a quote unless I get an elevation certificate. And like I never had to have one to get one in the first place. So do you know what that's about? They say it's a requirement.
That has to do with the Biggert Waters legislation, because under the Biggert Waters legislation, if you let your flood insurance policy lapse for a certain period of time, when you go back to pick up a new policy, it's required to be full risk rated under the Biggert Waters legislation if it meets the criteria of being an older building in an A zone, a V zone, or a D zone, which yours does. So So that's where that requirement's coming. Now that is the requirement that's being removed next week on Wednesday, May 1st.
Right, so this is the $2,000 worth that I don't want to have to spend in the next 2 weeks. So my policy expires on May 10th.
Okay.
So do I wait? And then the other question is, like, are the rates going to go back down? Did they just go up and are going to go back down? So should I let it elapse? I mean, it's not going to flood in May, but I mean, but do I let it elapse?
Oh, don't get me started on that subject. No, you don't let it lapse. No, don't let it lapse.
Then I have to get a survey?
You should be able to go to your insurance agent tomorrow, and the agent should be able to get the paperwork ready and have it ready to go by May 1st. I mean, it doesn't take that long to do it. He can do it tomorrow. He or she can do it tomorrow. They will hold it until May 1st rolls around when business opens. And that at that point, the insurance carrier, their software systems will be ready to accept those applications. So since yours doesn't expire until May 10th, you still have a window of opportunity to get all of that done on May 1. And if your insurance agent has questions, that's where the bulletin comes in that I showed you on the screen that's on the website.
Anybody in this section?
We have owned our house for about 20 years. We have had flood insurance for 20 years, and we were told that we were grandfathered, so we had the old rate for about $300 and some. About 3 years ago, it was bumped up for $3,000 all of a sudden. So that was in 2011. Through our insurance agent, he negotiated, it went down to 2,000 and something. And we were told that we needed an elevation certificate, which we got. And this year, we paid only $1,100. So I want to know, since we were grandfathered in, do we get a full rollback? The elevation certificate said that we are maybe half an inch below what they require because the new map shows that the flood level has increased in our area. So my question is, do we qualify for a full rollback or not?
I would have to look at your whole file to be able to answer the question, and I don't want to dodge the question, but there are so many intricacies to what you just said in a couple of minutes that I would be almost definitely off base if I didn't look at some of the particulars. So if you want, after we get done here, we can talk about your situation individually.
I was going to say that might be helpful to take that offline, and if people could, if possible, ask questions that are more general in nature, and then Edie will stay after the meeting to answer those more specific kinds of questions.
Well, I have a general question. Those flood maps are incredibly important to our rating, and do we have new maps for Palo Alto, Menlo Park, East Palo Alto? Just what's the status of the map? And if we don't like the where our home or property is on the map, is there an appeal process to say, I think I should be on this line because there's some pretty, things are very cut and dry on those things?
I'm going to let these two guys take that because I'm not the engineer. So
I can speak for the city of Palo Alto. The map has not changed with anything of substance since 1999. So there haven't been any recent changes since that time, and there are no planned ones that I'm aware of for the city of Palo Alto.
In San Mateo County, the maps were updated in October of 2012, and I don't know the next planned update. If anybody else has that information, they can share it.
there's a coastal study going on.
Right.
There's going to be probably some adjustments from that perspective.
Right.
Why is there such a disparity? Hello, can you hear me? Yeah. Why, since the maximum coverage is $250,000 for the dwelling and $100,000 for contents, why has there been such a disparity of rates across the board? Shouldn't there always be one rate? I mean, somebody's paying $1,300 a year, somebody's paying $3,000, somebody's paying $300. If the maximum coverage is $250 and $100, it should all be uniform. No one has ever been able to explain that.
It's a good question. I'll kind of explain it like this. There's a lot of different underwriting criteria that go into somebody's rate. So, for example, the age of the structure, whether it's in a low risk, high risk, or moderate risk flood zone, the amount of their deductible, do they have a basement? Because last time I checked, water flows downhill, so it will go right into the basement first, right? Is it a business? Is it a residence? It's sort of like the rates you can think of, like, for example...
homes next door she's talking about. Next door to each other.
Yeah.
The whole neighborhood's different.
Right. Well,
We all got it at the same time.
yeah, the rates, so you're talking about rate increases that you got, or just rates in general? Well, okay, so that is a good question that we get often, and I like to explore that, and I'm glad you brought it up, because this is a federal government program. So theoretically, if you and I went out and we gave 10 insurance agents the exact same underwriting information, we should get the exact same premium, because the rates are all federally set. There's a big binder, and the rate book is about 50 pages long. And most of the agents use rating software. So there's either, there's a couple of things that could be going on if you're going out and you have the same exact house and you're giving 10 agents the same exact underwriting information and requesting the same exact coverage. There could be a couple different things going on, but just so you know, the rates should all be the same. The premium
But I
should
can
come out
think of
the
a couple
same.
things too. I mean, if the one house is an older house and the house next door is a newer house, then they would be different.
They would.
And then sometimes
Yes.
if a neighbor has gone out and had a survey done, and the surveyor can show that the ground that the house is built on is higher than the base flood elevation, then they will qualify for something called a letter of map amendment. Those people would also pay less than someone who does not have this letter. So that might be another explanation for differences between neighbors.
No, I polled all the neighbors in a 2 square block area where I live on Channing, and it varies from $300 to $4,300.
Yeah, and it shouldn't, somebody's making a lot of money here.
Now, maybe
And
the
that
house is
sounds
built-
and that sounds probably like a separate offline meeting, but I have a more general question, if I may. The maps that were shown of Palo Alto and East Palo Alto in that 101 corridor during the first presentation, are those available on a website, or can we get copies of those maps which show us where we were historically, what projects are going to be going on, and I think it also showed us where we will be after those key projects are completed?
Yeah, those maps are different from the flood insurance rate maps. Yes, but why don't we talk at the end of the meeting and we'll get you stuff.
In some of the publicity leading up to this meeting, there was mention of ability to apply for an exception to the flood insurance rate that you're given. Could you discuss how that could be done?
That could mean, I'm thinking of two different ways. One is what we talked about as being the rollback of the full risk rating for that certain category of policyholder to the pre-firm subsidized rate that will occur next week. That could be one aspect of that. The other aspect could be, that comes to my mind, and maybe Joe will think of yet a third, but I'm thinking also of a lot of times we hear about something called the letter of map change or a letter of map amendment, where and this gets a little bit confusing, but basically if the structure is sitting on naturally high ground, or there's some kind of fill where You know, you have a mound of dirt, the house is on top of the dirt, the water comes in, it hits the base of the hill or the mountain, goes right back out, it doesn't touch the foundation of the house. That is a structure that is potentially eligible for what we call letter of map amendment. And so that is something that you would hire a surveyor, you would get an elevation certificate, you would submit a letter of map amendment for that purpose. But it's not the person, the average person that's just sitting, you know what I mean, flat on the ground, or even that person that, let's say, is on the coastline, but they're elevated on piers and posts 20 feet in the air, let's say, because the piers and the posts are going down into the sand, right? So when the wave comes in, it's going to take out those piers and posts, and that structure is going down. So it would be for, you know, that kind of topography arrangement. That's my layman's explanation.
Thank you.
Hi, so I'm kind of going to be along the same lines as these guys over here with inconsistencies in the insurance. And in my experience, we bought a house December 2012. We had a policy. We have a little cottage in the back. It was totaling just about $1,600 a year. We renewed it. It was a new policy because we moved in, but it never lapsed with us. We renewed it, and it renewed up to $7,800 a year. So that's what we currently pay. And I got probably 4 or 5 different insurance agencies, and they were totally inconsistent. For the cottage in the back, it was a $40,000 coverage, and it ranged anywhere from $2,300, which is the one we chose because that was the lowest rate, to $5,500 for a cottage. That cost $40,000 to replace. So I could basically rebuild it myself in 8 years for what I'm paying the plan. My neighbor, who moved in October 2013, exact same house, his house, elevation certificate was done on his house. Same guy did an elevation certificate on my house. His house was actually lower than my house. He paid $856 a year. Total inconsistencies throughout the board. So now with this, I mean, I understand we're going to get our money back, which is fantastic. I don't know how long that will take. Maybe you can answer that question. But when we do get our money back and when we go back to the subsidized rates, the pre-firm, because we're pre-firm houses, subsidized rates, is there a rubric or a chart that we can refer to make sure we're not being, you know what I mean? So we're not being taken advantage of by these insurance companies. Because what if we don't shop around? Or what if somebody doesn't know to shop around? Or doesn't have time or, whatever? Because I've never seen any chart that said if you're at a house at 6 feet below base flood elevation or 5 inches below base flood, you should be paying $5 a year versus $1,500 a year. I've never seen anything that I can even compare. Because how do I know that these insurance companies aren't just like throwing it, and they're saying, oh, we're using the software program from FEMA and blah, 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 and it should all be the same. But then I have data that show it's not the same. So who's telling the truth and who's not?
So I'm so impressed that you got all these terms down because this is really hard. So there's a couple of things. Yes, there is a couple of places that you can go if you want to see the actual rate charts. You can go to floodsmart.gov is the easiest website. That's the www.floodsmart.gov. It gives sample rates in there that I think are easy to find and easy to understand. However, they're going to be samples. And so that means when you're talking about rating a building based on an elevation certificate, the purpose of the elevation certificate is to get the very specific detailed underwriting information on that particular building, not your neighbors, not the guy 2 miles away, but on your building, because the site-specific information on your cottage could be very different than the guy across the street or the guy next door or the guy in back of you. So now with that said, the rate tables themselves, if you Google National Flood Insurance Program, there's a flood insurance agent manual. And the flood insurance agent manual, in fact, if you just Google National Flood Insurance Agent Manual, it would come right up. And you go to the ratings section. And in the ratings section, there are a whole series of examples in the back, both for pre-firm subsidized structures and for post-firm full risk rated structures, or for pre-firm structures that are full risk rated with elevation certificates. And it will give you some ideas. I think one thing that I really want to stress is that I do this 24/7. I love my job. I've been doing this for 25 years. And I had to buy a new pair of shoes about a month ago because things change really fast. They've been changing really fast in the flood insurance program, and I do this every single day. So that means for the insurance agents who are writing flood insurance, this is a small part of what they do in most cases. So they might write a couple of policies a year, maybe. I think we're going to, the bottom line is the changes are coming so fast that the agents, the information has to have time to filter down from the underwriting department to the agents who are in the field, especially with the legislation. And so I think there are checks and balances with the underwriters. So if the insurance agent needs help, they can always call the underwriter. And a lot of the insurance carriers who are writing flood insurance, they hire servicing companies who do this all the time. And those underwriters and actuaries are really very good. So if the agent needs assistance, the thing to do would be to call one of the underwriters. And also on the National Flood Insurance Program website is a document where we have listed all of the companies, the insurance carriers who write flood insurance, and toll-free numbers for that particular reason, so that you can call either the claims or the underwriting department and say, look, here's my policy number, and I need some help with this flood insurance premium. They can pull up your file right on the computer, and then they can talk to you about the specifics of your case. Because it's really hard for me to say, and I hear this all the time. I hear what you're saying. I do hear this all the time. And I train insurance agents. So a lot of my time is spent training insurance agents. But it is very confusing. But there is, a checks and balances there and assistance for the agents.
Now, on behalf of the folks here, is there anybody at FEMA, a live person who they could speak to answer questions, or are they forced really to just look at the web resource? What about people like Adam? Can he help them?
You know, the thing is, Adam Lizargo, he works with me. He's a partner. He's a consultant, but he's a partner, and he does insurance stuff. I think the biggest problem is that we don't have the actual underwriting file. And so it becomes even very difficult for us to be able to answer the specific rating questions without having the underwriting file is the problem. And the other issue is there is one of me and one of Adam, and we cover all of California, all of Arizona, all of Hawaii, all of Nevada, and the Pacific Trust Territories. So, because the agents are the ones that have access to your specific underwriting information, they are really the ones that you need to call. You need to call the agent, and then the agent can talk to the underwriter if there's an issue.
I just want to thank you for your presentation, but just for the residents, once again, with the rollback, how will they know for sure that they're involved in the rollback? Because again, for certain cities, there are certain residents that will still have the increase. So how will this notification come out? Should they expect it to come from their lender or from the insurance agency? What is the process?
The insurers are going to send written notifications. So you'll be hearing from the insurance carriers. It's not going to be May 1st, you're going to get a note in the mailbox. But you're going to get written notification, and they are going to make the adjustments as the policies come up for renewal and as new policies are issued. And there is a refund mechanism in there. We don't know a lot about it as far as it applies to the people who were required to be full risk rated with the elevation certificates as a result of Section 205 of the Bigger Waters legislation. And I want to be specific about that. So if it was a situation where you are paying a higher premium by being full risk rated than if you took the subsidized pre-firm rated premium, then they'll put you in the pre-firm subsidized premium. So whatever the premium is, it's more advantageous to you. Some people, when they got elevation certificates and surveys, they found out that they were paying a cheaper premium. And so that's more beneficial to them than the old subsidized premium. But some people, it was just a reverse. So there'll be a mechanism there.
To follow up on Lisa's question, the time a person should receive something in the mail is when it's up for renewal and not before? What would people expect?
We don't know exactly. We don't know. Well, I'm being perfectly honest with you. So there is going to be a written notification. My understanding is as these policies come up for renewal or new policies are issued, that will be the trigger, but there will be a notification that will go out to the property owners so that you'll know if you're impacted by this rollback or repeal.
From the insurance agent.
Yes, from the insurance carrier, right? And also, if you're due a refund, you will also be notified in writing about that. The timing, I'm not so sure about.
So rather than people waiting, would it be better for people to be proactive and contact their insurance carrier after May 1st and inquire about a refund?
You can do that. You can do that. It's certainly not going to hurt. Some insurance agents will probably maybe not know that there's a May 1st trigger date. Others will. But that's why, I find my best resources when I tell the property owners, because they retain the information in a lot of cases that they can then share with the insurance agent. So if it's one of those situations where your insurance agent has just not become aware of it yet, again, this is all really brand spanking new. So we're trying to work. This is a big ship to turn around in the middle of the ocean. It's like trying to turn the Titanic upside down. So I think we just need to be a little bit patient, and it will definitely get done.
I have flood insurance because I'm told I have to. It's not a choice. I look at this, unlike your attitude, I think, on flood insurance, I look at it as extortion. And I want to get out of my requirement. So I'm told that there's a process for getting a LOMA, and is there somebody in the city, perhaps? I'm told I have to go work with the city. I can't just go to FEMA. And, well, okay, for the record, he shook his head.
Yeah, after you're done, I'll answer your question.
I want to know, I'd like a step-by-step process shown to me, not necessarily tonight, but a website that tells me exactly what I have to do in order to try and get out of this requirement.
Can I start? Okay. I'll start and I'll try to answer that for you. So what you're looking for, which you may or may not qualify for, is called a letter of map amendment. And and you get one of those if you can show that the ground that your house is built on is higher than the base flood elevation. So the only way you're able to do that is by hiring a surveyor to come out and survey your land. You don't have to work through the city. The application goes directly from you as a property owner or homeowner to FEMA. On the city's website, we do have some fact sheets that kind of explain the process. You also might want to go onto the FEMA website and just type in letter of map amendment, and all the forms and the instructions will be included there. But basically, that's the challenge that you have is whether or not you can show that the ground, not the house, not the floor of the house, but the ground that your house is sitting on, you have to show that that ground is higher than the base flood elevation. Now, the one thing that the city can do to help you is that we have records of all the people in the city that have lomas. So sometimes it helps if you contact the city. We can look in our records and we can show you the people around you that have got lomas. And if there aren't any, that probably tells you it's probably going to be difficult. Whereas if there's a bunch of people right around you that have already qualified, then that might, at least in your mind, increase your odds of being able to get one. So that information you can get from the city.
So I have to get the forms from FEMA, and then I have an elevation certificate. I had a survey done years ago, but now I've had to get a new elevation certificate last fall. FEMA said I had to. Does that count as whatever it shows for my elevation? Or do I have to have a whole other survey?
There's probably information on that elevation certificate that will help a person that understands what a loma is. They can tell you whether or not you're going to qualify or not, and that's something that the city might be able to help you with. If you want to come in, we can look at your elevation certificate and explain it to you and advise you as to whether or not we think you have a good chance or not of getting a loma.
You? Sure. What's your name? Thank you.
I'm going to change the topic a little bit. A lot of the old houses in Palo Alto were built with basements. Many of those houses are up above grade. The basement obviously isn't. But I was also told when I first was forced into getting a flood insurance, that basements aren't covered. And if basements aren't covered and your house is above the floodplain, why doesn't that help some? I'm talking about real basements, not just a hole in the ground, but a concrete basement that's obviously exposed to the weather outside, and nothing's going to happen to it if it gets wet inside, if it's unfinished and it's just a basement. So how does that, can anybody do anything about that, or is it just worthless to even try? My insurance agent just said if you go tell FEMA you have a basement, they'll increase your rates. So.
Okay, so the rates are specifically designed because we do have limited coverage in basements, but we do know that the water runs downhill. So if it comes to a house with a basement, it's going in the basement more than likely, if it gets in at all. So what's covered in a basement is essentially the foundation elements and the required utility connections and any machinery and equipment that's servicing the building, which is a lot of things in a basement. What's not covered are a lot of the personal effects and the finishes that would be in a finished basement, if you have a finished basement. If it's an unfinished basement, then you're probably in better shape because you'll have more coverage, because those are the things that we do cover. It's not intended to remake it as living space, because from a safety and soundness standpoint, we see a basement that's in a high-risk area as a high risk. We don't really want people sleeping in there because that's where the water's going to go when it floods. And if the building's in a high-risk area, then that overtakes somebody in the middle of the night, and that person's probably not getting out of the basement. So that's the reason why that we have that. Now the rate chart, or the rate that you're charged for a with basement building, only reflects the damages that we would cover in a basement. So you're not being required to pay for things that you would not be covered for. And so if we were going to cover those additional things, which a lot of people on the East Coast who do have basements, and those are finished, nice basements, that's a different issue at claim time. That's a completely different conversation because they want to have those things covered, but we would have to increase the premiums to reflect that coverage for those finished items in the basement. Good question.
But basically, the basement is, if you have nothing in it that you care about being covered and isn't covered, then the fact that your building is elevated doesn't help you at all. Just because the basement's there?
The basement does have coverage. The finished elements in the basement are not covered. Finishes like paint, carpeting, furniture, those types of things. But the basement itself, that is probably going to have a significant impact if it's flooded and you have a basement building, and those items would be covered under your flood insurance policy. And actually, in the policy, there's a very specific section that addresses what would be covered in a basement, both under the building coverage and the contents coverage, just so that it's a clear list for people if they're interested.
It looks like that the elevation certificate is determine the cost of the insurance. The elevation certificate is, I think, is a wrong term, because look at her house and the house next door. I think the structure of the house, and it come to my question, what can FEMA or the engineer can recommend to us? What can we do so we can bypass this flood? I received a note that they need to do a survey or whatever, so I prepare myself. I don't have a basement, but I have a crawl space. Every vent I have, I put bolt in it, and I look for silicone, so I'm going to seal it. And I dig 6-foot deep hole, 4 feet by 4 feet, and put sump pump. Because what I wanted to do, I want to do something. Because elevation certificate, I think, is a wrong term, because her house and the next door, the structure of the house was different. That's what the survey was determined, was not the elevation. Because when our house here on Daphne Way in East Palo Alto, when it was flooded in December 2012, the water ran and go all the way to the other side. Our house didn't flood because the water ran on the street. So I think the FEMA or whoever the engineer is, they have to look at the home. And I think that flood elevation certificate is fake. One people, they'll tell me $700, $1,100, and $500 to the same certificate. That's too much.
Well, you shouldn't be getting, again, getting back to the conversation that we had over here, you shouldn't, if you have an elevation certificate on your building, and the term elevation certificate is the name of the form. It's not really a process, or it doesn't really refer to anything specific other than that is a form that we use to determine the specific underwriting criteria for your building. Like in your case, that the house is built on a crawl space. And so it gives us the diagram number. It tells us what type of construction it is, whether it's residential, commercial. It tells me that it's not a basement building, but it is a crawl space building. It will report whether there is flood venting so that the water can go in and come right back out. So there's a lot of different criteria that it reports that we would use to rate the building, because we have over the years accumulated a number of statistics. So we know that structures that are built compliant to the floodplain management regulations and ordinances are at least 82% less likely to flood. And when they do flood, they sustain about 25% less damage. So we hope that during the building process, the permit process, that's why it's regulated, to capture those regulations and to make sure they're incorporated in any improvements or new building construction. Again, to keep people out of harm's way, because we really don't want you to have to go through a flood. We'd like to see the water stay away altogether. And the notion of employing mitigation projects and floodplain management projects to protect people is the primary. It's the primary vehicle that we'd like. I mean, it'd be great if everybody was not in a high-risk area.
I'm going to add just one comment with respect to that. Someone said that in past events that their house hasn't flooded, and they're kind of wondering why they're on the floodplain map. Well, the fact is that the floodplain maps are based on a theoretical event called the 1% or 100-year flood, and in recent history that has not occurred in this area, so we have not actually seen what that is like. So the largest event we've had to date was the one in 1998, which, as Len said, was about a 45-year storm. So if the 100-year or 1% event were to happen, the extent of the flooding and the damages would be much higher than what we saw in 1998, and that is what's reflected on these flood insurance maps.
So I wanted to ask, FEMA covers more than floods, right? FEMA covers earthquakes and tornadoes and hurricanes and everything else. And in my assumption, my house is more likely to get hurt by an earthquake than a flood. And what about the people who live, are we charging everybody for earthquake insurance? We don't enforce that. I don't know anything about hurricanes or tornadoes. If we make people in Florida pay for tornado insurance, but FEMA covers everything. So I don't understand why doesn't every homeowner have to pay like $50 a year, whatever, for anything that any natural disaster that might possibly happen, whether it's a landslide or whatever. So I'd like to understand that a little bit more.
So would I. That makes too much sense, doesn't it?
So maybe you can come and answer
We're FEMA's an emergency response organization. So we got into the business of the flood insurance program because flooding kills the most people and it causes the most damage nationwide. However, we don't offer earthquake insurance. We don't offer fire insurance. We don't have any programs for those specifically. We participate in the emergency response portion of any disaster, including terrorist acts or anything where we're called upon by the local community or the state to assist. So we are definitely emergency response, but we don't have insurance programs in those other areas like we do the National Flood Insurance Program. But that is a good idea.
We can't opt out of earthquake insurance. We can't opt out of flood insurance, obviously.
Yeah.
But yet, if I have an earthquake, you're going to cover me as well as if I have a flood, right?
Well, again, no, not so much. And I think what I think what you're talking about more is the disaster assistance. So the programs, and Olivia is a real expert on disaster assistance, but it's limited. Right. So it's not really. It's great that we have it, but it's not necessarily designed like an insurance program or policy to make you whole.
If I didn't have flood insurance and I don't have earthquake insurance, and I have either one of those, FEMA is going to help with that disaster.
No.
Not without flood insurance.
You have to have a presidentially declared disaster.
Exactly, I understand that.
To be covered, your first line of defense is always insurance, whether that's from flood, from earthquake, from fire. So once again, if it is a federally declared disaster, if it's an earthquake or a flood, your first defense is insurance. If you don't have insurance, You may register, apply for FEMA grants, which Edie did say averages 7,000 to 8,000 possibly, and then go to an SBA disaster loan, which he stated.
You're forcing this flood insurance on us.
Well, and in terms of with FEMA, flooding is the only natural disaster that we are able to scientifically map and provide you as a consumer, as a homeowner, your risk. You understand that earthquake is a risk. We all know that. We all understand that. But in terms of flood insurance, we can specifically pinpoint based upon the engineering where it would flood at the 1% chance, meaning that it could flood every year at a 1% chance. So if you have a 30-year mortgage, and you live in a high-risk flood zone, you have a very high probability that your home is going to flood. And without that flood insurance, and without a federal, and there's a flooding that occurs, if there's no federal disaster declaration, what are you going to do? In terms of flooding, we always refer to natural events. However, what if a pipeline bursts in your home? What if a swimming pool were to overflood? So we always refer to natural disasters or natural events in terms of flooding, but there's also, could be man-made. You refer to an earthquake. If we had a 9.0 here in the Bay Area, those levees can breach, and it could flood. And what if you didn't have flood insurance? So we have to think about more in terms of, I understand that there is that financial implication in terms of flooding, but there's also the risk. And that's, as FEMA's mission, that's part of what we do, is our responsibility is to inform you of your risks and what that means. And yes, as a consumer, you can make a choice. Buy the flood insurance, get the LOMA to remove yourself out, but you understand the consequences. But once again, I understand that, but it is the only natural, it's the only in terms of natural disasters that we can pinpoint and that we can tell you what your risks are.
Okay, so we're going to wrap this up in about 8 minutes. I think we'll finish at 8:30, and then we'll stick around after that to answer individual questions. But let's try to take a few more questions before we wrap up.
On the subject of earthquakes and floods, if the San Francisco Creek's Searsville Dam were damaged in an earthquake and created a flood as a result of that, would that be covered?
Yes.
Under flood insurance?
Yes.
Is there anyone who has not asked a question yet that would like to ask one? No? Okay. You get a second chance.
So my question refers to the potential 18% increase in flood insurance over the next however many years under the new HFIAA legislation. It's obviously much better than my 200% increase that happened a year ago, so I'm actually very excited about only 18% increase, but at what point will that stop? I mean, will it get to that 200% increase? You know, will it get me back to my $7,800 that's due per year in 6 years or 7 years? And then also, you know, for resale for my house, if I move out in 5 years, is that new person going to come in knowing that they're going to owe $7,000 or $5,000 a year or whatever for flood insurance? At what point will that 18% stop, if it ever will?
I don't know. It's not to say that your particular premium in any certain category is going to go up 18% per year. And we're not really sure how all that's working, to be flat out honest with you. I mean, they're looking at that and working with Congress right now on how they want the legislation interpreted. So honestly, we really don't know. And you also, the other variable that you don't know is, you know, are they going to be able to do some kind of floodplain management project or flood control project that would change or update the maps that would make you less at risk and remove the structure? Well, maybe, maybe not. Or on the converse, are we going to have a huge earthquake and the dams are going to break and the levees won't hold, and then we're going to be looking at a different set of data for flooding?
So what you just
Don't know.
referred to with, building up the levees a little more or whatever, there's some pump stations. We live in San Mateo, not in this area, but in San Mateo. And there are some pump stations that we're talking about fixing and getting, updated and whatever to help us probably not get out of the flood zone, but to put us into a nicer flood zone. We're in AE right now, which everyone that I talked to was like, oh, AE, that's like the worst ever. So if we could get into like an H flood zone or something else, I mean, that'll obviously help. But where does the federal government stand? I don't know if you can answer this about the federal government in general, or does FEMA help with funding any of that stuff if it's going to get us out of an A zone into a nicer designation? Which means less risk, which means less money that FEMA's going to have to pay out to help us out. Is there any potential grant opportunity for the federal government to help the cities in rebuilding that stuff?
There are, but honestly, I know just enough to be dangerous about that information. The programs exist. In fact, Joe might have more information on that. The legislation, both the Biggert Waters legislation and the new legislation, that's what they would like to do, is to mitigate before the flooding occurs. I mean, that's always the most ideal situation. And, I think it all goes back to where do you get the money to do that? I mean, these are expensive mitigation options in most cases if they're impacting, a whole community.
But I think the community, I mean, if you have 250,000 policies, people who are paying $3,000 a year versus $300 a year versus $1,300 a year, or in my case, $7,800 a year, I'd be super stoked to just pay like $500 a year for the next, 25 years or something to pay into a fund, So, and I'm sure the rest of my neighborhood and the other communities would too, instead of paying $3,000 a year, paying something on the longer term, something consistent, kind of like you guys you're going to implement a surcharge, like $250 surcharge, so something like that. So
yeah, there's been a lot of discussions too about putting those types of things in the hands of the communities under the legislation. So it's all kind of being roundtabled, and I don't know if
I was just going to say that's exactly what we're heading towards for the communities down here. And that's what I alluded to at the beginning, was kind of transplanting your average, at least in these communities, $1,300 a year escalating payment for a payment that's at most 33% of that, and getting out of the flood insurance program. So that's kind of what the JPA has been exploring in terms of financing options for these communities. To get to your other point, Dana, about the grants, there are two grant programs. There's the Flood Mitigation Assistance Program, and there's the Hazard Mitigation Grant Program. And I don't know about what the city of San Mateo has participated in, or I don't know if Palo Alto, but in a hazard mitigation plan. But I do know that if the cities have done that, then they're eligible for those grant programs. And there's a certain percentage of all federally declared disasters, the money that goes out, a certain percentage that's kept for mitigation activities. At least that was the case about 10 years ago. I'm assuming that's still the case. And
yeah, you're right.
Cities have to pay into.
No, they don't have to pay into. They have to be eligible for, and they're eligible if they've done the steps to do mitigation plans. And I know that ABAG did a Bay Area-wide plan that a lot of the cities bought into. And maybe you can.
Yeah, no, he's exactly right, and so some of the there's also what they call a pre-disaster mitigation program, so a PDM program, but they're funded in different ways, but primarily they're grant monies that are used for elevating, relocating structures, trying to get structures out of harm's way. In most cases, they are competitive programs. So the communities make recommendations for projects in their communities. They identify projects, and the applications go to the state, the Office of Emergency Services, and then the Office of Emergency Services prioritizes those and makes recommendations to FEMA. And there's finite pots of money that's allocated for those types of things. So just because you submit an application doesn't mean you will be a community that's selected. In fact, the application grant program period just opened. So it's open from now until, it's a short window, but it's open until June. So
that's for the pre-disaster mitigation program.
that's for the flood mitigation assistance and the pre-disaster mitigation program. The hazard mitigation program comes into play when there's a federally declared disaster. That's money that's available after the fact, so to speak.
Okay, it's 9:30. I think we're going to wrap it up. I want to thank the folks at the Media Center who have been cable casting this meeting. We're going to put it on their archive so that people could watch it if you wanted to watch it again. If there was some things on the slides that you missed, we'll be putting information about this meeting both on the City of Palo Alto website, which is cityofpaloalto.org, as well as on the JPA's website, which is SFC for San Francisco Creek, sfcjpa.org. We'll put we'll put copies of the PowerPoint presentations and other information and information on how to watch this again on your computer at the Media Center website on our web pages. So look for that. I thank you all for coming this evening. We'll try to stick around and answer more questions, but at this point, Media Center, let's sign off. Thank you.